Today we're going to discuss about financial management. This is the first part in the online lecture series where we'll discuss about financial management as a subject. This video is helpful for undergraduate students and anyone who is interested to know what is financial management. My name is Prasenjit Roy. I have qualified PhD, NET JRF and MCom in Accountancy and Finance. Presently, I am an assistant professor in the Pune Institute of Business Management at Guwahati campus. Let's begin. So what is financial management? When we talk about financial management, we notice the word financial. So without understanding what is finance, we cannot understand what is financial management. So when we talk about what is finance, one thing that comes across our mind is that money. Finance is synonymous to the word money, where we can see we have currency, we have monetary transactions, we have financial instruments, such as bank deposit, okay, etc. So when we talk about finance, the dictionary defines it as the circulation of money, the granting of credit, making of investments, and provision of banking facilities. Although this is a narrow view on finance, as there are various other facets that are included in the term finance. Okay, and another thing which we notice is that it is often regarded as the backbone of an economy. Why? Because without financial resources, no company, no economy will function. It's a universal truth. Will function. This is an universal truth that without finance, no company or economy will function. Okay. So when we say finance, as per this definition, it means circulation of money, okay, provision of investments, okay, provision of banking facilities, and provision of granting of credit. Okay, so these are the subsets of finance which are involved in this entire topic. So now, what are the various areas in finance? Usually, in order to understand or have a clarity in our understanding, academically, finance is taught in the universities in three groups. The first one being financial management, the second one being capital markets, and the third one being investments. So here our main focus would be with the first group, that is financial management. Financial management is also known as corporate finance. Why? Because it particularly focuses in creating value for company, creating value for the companies. Okay, which kind of company? Corporate entities. Okay. Primarily, corporate entities are involved in equity shares. Okay, so financial management tries to increase the market value of these equity shares so that the value of the company also increases with time. Okay. So when we talk about financial management in terms of corporate finance, here usually few questions are initiated in order to first start the operation of any company. The first question being, what are the kinds of assets required to purchase? from where these assets will be purchased so that the cost is less and benefit is more. Okay, and after this, dividend decision. These are the questions that are being answered through financial management. We'll discuss all these things in detail in our subsequent video. Now, the second part is capital market. So the word capital signifies long-term financial instrument. Whenever the word capital is mentioned in finance or in financial management, we should always regard it to be long-term financial instrument. So here, particularly the interest rates and the stock and the bond prices are studied, okay, with the help of various institutions, or more or so focusing on the financial institutions such as banks, okay, NBFCs, okay, insurance companies, okay, which are included in NBFCs, then cooperatives, etc. We have many financial institutions. Okay, these are all known as financial institutions which are studied in capital market. So these financial institutions act as an intermediary in order to connect the savers with the borrowers. So savers may be any individual such as you, me, or any organization such as A Limited, okay, B Limited. Okay, they have surplus money, they are saving it with the intermediary, and borrowers are any company or any individual who are requiring the money in order to utilize it for their purposes. Okay, it may be again A, B, C, etc. So in capital markets, we study particularly the functioning of financial institutions such as banks, okay, investment banks, mutual funds, etc. It is also regulated by governmental agencies such as RBI and SEBI, and also IRDA and Pension Fund Regulatory Development Authority. So these are the primary organizations that control and regulate the capital market. Apart from this, we also have Ministry of Finance and Ministry of Corporate Affairs. Ministry of Corporate Affairs. So this is the second part of our second area in finance. Okay, now moving on to the third area. Here we talk about investment. So here investment refers to the equity investment, okay, debt investment, okay, or deposit investment, okay, or any other financial instruments. Okay, so here what is being studied? The various risk associated with all this individual risk associated with these instruments, these financial instruments. So we study the risk involved in equity, in debt, in deposit, in any other financial instrument. For example, the risk associated in equity is a bit high. High risk is involved. Okay. Now, this risk associated with debt is a bit low. Okay, and in deposits such as bank, okay, it's almost nil. Why? Because bank are already guaranteeing you the return on their deposits. Okay, but in equity, this guarantee is not there. Okay, you will be only provided with dividend when company will attain profit, and in the event where there is loss, company will not provide any dividend. Likewise, the same applies with debt when you compare it with deposit. When a company is taking debt, whether it is gaining or losing money, it is irrelevant with the debenture holder or the creditors. They are bound to receive their money at the end of the tenure. So here in investment, we study the risk associated with all these instruments and then decide on preparing a portfolio, which is a combination of all these individual securities. Okay, and select the one which has minimum risk and maximum return. Okay, minimum risk and maximum return. So here in portfolio theory, we study various stocks and security to prepare a basket where there will be numerous stocks. Okay, so this entire topic is taken up in a subject known as security analysis and portfolio management. So this subject is basically beyond the scope of financial management, so we will not discuss this thing in detail in this segment. Just we will know that these are the risk, these are the return characteristics that are associated with all these financial instruments. Now, when we talk about finance within an organization, we need to first understand what is the organizational structure. Okay, what is the organizational structure of a corporate entity? Chart similar to the one that is shown here. It begins with the board of directors, who are the top governing body, followed by the chairperson of the board, who is generally the highest ranking individual. The CEO comes next, but often it is seen that the chairperson of the board serves as the CEO. Below the CEO, we have Chief Operating Officer and Chief Financial Officer. So, the Chief Operating Officer directs the firm's operations. That includes marketing, okay, that includes marketing, sales, production, etc. The next part under the CEO is the Chief Financial Officer, who is generally a senior vice president and the third ranking officer in charge of accounting, finance, credit, okay, and other financial activity. So the CFO work in accordance with the guidelines that are laid down by the board of directors and function for the benefit of the company in order to achieve the desired results. Often it is seen that if the firm is publicly owned, the CEO and the CFO must both certify to the SEBI, and in their certification they should declare that the annual reports would be issued or would be released to the stockholders at an accurate interval of time. So here, this entire structure is important from financial management point of view, because here these are the decisions which are directly relatable with financial management. So once these things are functioning smoothly, it will then reflect towards a more smoother operations in the other activities of the company. Finance grew out of economics and accounting. This is because economist has developed a notion that assets value is based on future cash inflow or future cash flow. For example, suppose we are acquiring a machine today for rupees 10 lakhs. The decision for acquiring this machine at 10 lakhs is because we are anticipating that this investment will give us certain return after a period of time, say suppose 5 years. That is, it might give us later on 12 lakhs. So this anticipation creates the value of the asset which we are going to invest now. Hence, this entire notion is developed by economics, which gives us the information in order to identify the kind of asset we are going to purchase. So people who are working in finance should have knowledge of both accountancy and economics in order to identify exactly and decide rationally the various decision making they are going to do for purchasing an asset. Thus, we can say that financial management is the process of efficiently estimating our requirements, raising of money, handling and allocating of financial resources for creating value of a corporation as well as profit in the long run. So here there are 4 dimensions to financial management in the company. The first one being requirements. The second one being raising of the money based on the requirements. Suppose the requirements suggest us that our business needs 50 lakhs. Okay, so in here we'll raise 50 lakhs, say suppose 10 lakhs from my own pocket, 20 lakhs from bank, okay, remaining 20 lakhs from equity. Here this entire financing is done in a 3-way format. After that, we need to handle the cash and allocate it as per the requirement. What was the requirement? Suppose we need to purchase the asset of rupees 20 lakhs. Okay, asset here means suppose machinery, then land for rupees 10 lakhs, raw materials for 10 lakhs, okay, office for remaining 10 lakhs. So here we are utilizing our entire requirement through raising and acquiring the asset. The last one being dividend. Once we properly use our resources, we need to generate profit, and out of this profit we need to give dividend or keep the money with us as reserves for our future use. Okay, this determines the value of the company. So when a company is issuing dividend or utilizing the money for future projects, it creates positive sentiments in the market, which ultimately affects the share price, and it goes up. So this is how financial management affects the value of the company and helps it in the long run to become a greater or bigger entity. We'll discuss about this with a case study in our subsequent classes. So now, for your better understanding, I have prepared certain questions which will be helpful for you to test yourself. So these questions are: what are the 3 areas of finance? Are these areas independent of each other? Who is a CFO? What are his responsibilities? What is the relationship between accounting, economics, and finance? Does any not-for-profit organization such as hospitals, schools, and universities require CFO? Why and why not? Send in your answers via email to thealttutor@gmail.com. Thank you for watching. Please subscribe, like, and press the notification bell for more updates. And stay tuned for the next video. Thank you.